So in the last 2 weeks prior to the current week, we discussed more about how the accounting system works, the mechanics of accounting we discussed, and then we moved into the different terms that generally appear in a financial statements, particularly the balance sheet and profit and loss account. We also discussed a bit about the cash flow statement. In the last week, actually, we discussed a case on the cash flow statement to see how one can take a due diligence on that one. But the core of this whole module, the first module, 3 weeks module, is that the financial statement analysis. We also call how to assess the financial health of a business. Like when you go to the doctor and you say that you are not well, when the doctor gives you certain tests to be conducted, and we go there and we take certain test, and the doctor sees the test report to understand what is the problem for this particular person. So he is assessing the health of human body. Similarly, what we are trying to do that using the financial statements, we are trying to understand how healthy the business is. So that is the primary objective of the whole financial statement analysis. Okay. Now the question is that how do I assess? What is the kind of a framework we will develop to assess the financial health of a business? Like doctors, they have their own way of measuring the individual's health. Like they take the blood test, the urine test, then blood pressure, right? They're like that, X-ray, like that. There are so many things that they do to figure it out what is the problem, where the problem lies. Similarly, we need to have a structure. So the structure which we created was one of the very old and famous structure called the DuPont chart, which trying to measure what are the drivers to the profitability. Now the question is that how do I measure the profitability of a business? To whom I will measure the profitability? So we can take a call that ultimately the promoters or the owners of the business, shareholders are the ultimate owner of the business. We will try to measure the profitability of the owners. Now the question is that what are the things that drive this profitability? So in the framework which we created, we said that there are fundamentally the 4 drivers. Now I'm adding one more driver, the 5th driver also. Asset management, cost management, these are the 2 fundamental drivers for the business. So if you want to improve the business, right, and you want to gain a long-term sustainable competitive advantage for a business, you need to be very efficient in managing your assets. You need to be very efficient in managing your cost. I would say these 2 are fundamental drivers to the profitability. Now, the question arises, the next issue is that one, is it possible for me to increase the profitability which has been created through the asset management and the cost management or profit management? Yes, it is possible, provided if these 2 drivers are strong. If these 2 drivers are not strong, then whatever we try to do, they may actually fire back, right? So we need to be very careful. Assuming a business is pretty good in managing the asset, the business is also pretty good in managing the cost, then the next issue is that how I can improve this further into the higher profitability. Then we get one more driver to the profitability, that the 3rd driver is that how I leverage my suppliers, right? Suppliers gives you goods on a credit basis without charging any explicit interest. They may charge some implicit interest, but you don't need to pay for that explicitly on that one. So this is where we say that one, the suppliers or current liabilities management comes into, or payables management comes into the picture. So you can see that there is an improvement that is happening because of this current liabilities or the payables on that one. Then the 4th driver comes into the debt management or the leverage management. By borrowing, it is possible for us to improve the profitability to the equity holders. How is it possible? Because we borrow at let's say at 10% or 12%, and if we're able to use this money to go for let's say 20% or 25% return from the business, so the balance, the remainder of the business return and the interest rate accrue to the shareholders. So this shareholder, therefore the shareholder get benefit out of this one. So this is our 4th driver. The last driver is actually one of the partner in this business is that the debt holder and equity holders are there with us, but the government is also with us. The only difference is the government is not putting money, but still it wants some return. Whereas the debt holder puts some money, they want some return. Equity holder puts some money and then they want return. Whereas the government is not putting any amount in the business, but it expects you to pay a certain return. That is what we call the tax. Then the last issue is that how do we manage the tax? Sometimes, depending on the country, depending on the period you are, it is possible to leverage certain tax provision and improve the return to the shareholders. That's what the last driver. Today in India, it is not very significant. Most companies, if you look into that, the tax management contribution is very little on that one. So this is the kind of a framework which we developed in this one. The DuPont chart which we developed is much useful on that one. So this is in general the theoretical discussion behind this particular topic. So we use certain ratios to measure each one of these drivers to the profitability. Asset turnover ratio, we measure revenue by asset. Profit margin, we measure profit by revenue. Then return on capital employed, we measure the profit divided by total asset minus current liabilities. So what we call as a net investment in the business. And then similarly, the return on equity is that profit before tax divided by equity holders fund or shareholders fund. Like that, we have different measures. We discuss in the regular lecture video each and every ratio in detail. But beyond some point of time, there is no point in remembering these ratios again. Better to create a structure. I created one structure and gave it to you. And you always can modify. You can create your own structure. You can add more ratios, reduce ratios. Everything is very, very flexible. That is, you need to have a comfort of what are the ratios which we are using on that one. Let's take our structure and go through. But before that, we will get into that case. We have two cases. Depending on the time, we will decide whether we need to do the second case or not. Probably second case we can quickly wrap up. We'll spend more time on the first case. This company, Renuka Sugars, is one of the large sugar company. And we know that sugar is something that is used on a daily basis, and then there's a good demand, particularly countries like India. There's a huge demand for the sugar. And Renuka Sugar entered into that business, and it has a couple of plants in India. And as a kind of international diversification, it also went and acquired or set up a plant in Brazil. Brazil is a country which is a top producer in the sugar cane and sugar, and therefore they went and established a unit there. So as a business strategy, it is a pretty good strategy. That is, you have a good presence in a country where sugar cane is grown a very large quantity, and you become one of the top producers in that country. And you also have a strong presence in a country which is consumes the sugar to a large extent. That's what this company's strategy, which is good. And what has happened, this strategy was okay initially, it was going well, but in 2014, when you look into that, things have gone very badly. So we'll just see the numbers here. So in 2014, this let's take profit after tax or profit before tax, any number we can take. In 2009 and 10, we had a very good time, and 12 it has deteriorated, 13 it has further deteriorated, and 2014 this has entirely become a negative. So this is a problem. The strategy is good, the company is doing everything rightly, but still the profitability has taken a beating. So if you have run through this the management discussion, you would figure it out what is the problem which is happening in this particular industry. There are two things which are happening. One is that sugar prices international sugar prices have dropped substantially from what it used to be in 2008-9 when the commodity boom was there. But subsequently, the sugar prices have dropped down significantly. That's one thing. The second reason is that, unfortunately, the sugar input prices are not declining. It's not matching with the sugar price decline. Because when you look into that particular country like India, where the sugar cane prices are fixed by the government, state government fixes what we call the minimum support price for the most agricultural products, they fix that one. To ensure that the farmers get a decent return on the product which they are growing on that one. So the sugar prices are not adjusting to the sugar price, sugar cane. Companies are trying to survive, so they also try to use some of this byproduct or a joint product that is coming out of the sugarcane process and see whether they can add any value on that one. Parallelly, some developments are happening in the industry where part of the ethanol is now being blended with the regular fuel oil, and then therefore they expect that this would give them some contribution, which is happening, but it's not again giving them an adequate reward on that one. So we have a few questions. This is the background of this one. The question is that as an analyst working for a state-owned bank and having a large loan exposure, you are required to analyze the financial health of the company and prepare a note to the credit review committee. There's a committee which should typically review the credit of various entities, particularly the large exposure, and they will take a call what to do with this kind of a situation. So we need to tell this to the credit review committee, how is the financial health of the business. If the company submits a loan application for 500 crore to augment the working capital, now the question is that as a banker, would you recommend this favorably? Would you sanction this particular loan? Then there's also one more supplement question. Now we are taking the different role because you are sitting in a private equity firm and this company has now approached you to issue the shares to your company. So the price they were asking is for 15 rupees per share, 20 million quantity against the current market price of 12. Whereas typically in the private placement, the companies would expect slightly a higher return compared to the current market price. For example, if you want to go and buy a 20 million shares in the market, definitely by then the market prices would have gone up significantly. You may not be able to buy at 12 rupee. When you want to buy 1,000 shares, probably you can buy at 12 rupee. But if you are trying to buy 20 million shares, the prices will shoot up to a very large extent. Suddenly there is such a large volume demand is happening. The market may not have that much of a depth to hold the price at 12. So that's what the companies will try to leverage, saying that my true price is not 12, my price is slightly better than that. Markets are not that much capable of understanding my profitability or the future profitability of the business. So the company is asking for 15 rupee. Now the question is that would you recommend this particular investment? Then finally the question is that how your analysis are different between to the eyes of a lender and to the eyes of the equity holder. What are the things which you need to look when you are looking the business as a lender, and what are the things you will look when you are looking the business as an equity investor? These are some of the things which we want to discuss in this particular case. So before I go through the case, I just want to take your views on the case. Then we will put numbers and then see how things are happening on this one. So Umar Khan says that he purchased my book. Great, congratulations. Hopefully you read that book fully. Most of the things we discuss in the class, but anyway, you supplement that one. Okay. If you like the book, please give some positive feedback. If you like. If you don't like, just leave it. Okay, let's come back to that questions. So what do you say as a banker? Would you what is your view as a banker? What is that you will tell to the business review, the credit review committee, or to the application for an additional working capital loan of 500 crore this company is asking? What do you say? Would you consider favorably or say that no, we cannot give any more money to this company? Well, at a very high level, I'm not getting into the details. I'm asking you, based on whatever we discussed, without getting into any analysis, by just seeing that profit and loss account and the balance sheet number, what is your overall impression about the company? Okay, Rossi says the debt equity ratio is high. What does it mean? You don't want to give money anymore? Is that impression? Since the debt equity ratio is already high, let's not give any more exposure, right? Yeah, okay, good. That's good. That's a valid point. Good. Then, what else? Any other view? So we are not going to give a credit. That much is clear. That's what Rossi said. But I think many of you would also agree. Cost of debt financing is high. Additional debt will cause into um, insolvency further, or maybe increase further. Yeah, cost of debt is high. DSAR has gone down, increase. Okay. So all of you said that this company is no more credit worthy. I cannot give you. Right? That point is well taken. We'll see that one, whether we need to revise that view later. But what about your recommendation to the credit review committee? What do you tell to the credit review committee? Because the bank is already having a huge exposure with this company. You have a large exposure. The leverage ratio is not good, right? Yes, Meg. You are right. So we are all with you, saying that we cannot give, since we too debt-ridden company, we cannot give any more loan. But what is our view for the loan already we have given to them? So we look into that, the company, we have already given how much loan. We look into that, the loan. So there's already some, in 2014 compared to 2010, we already gave 3,900 crore. Why it is there? In the report is there, no? The loan which has given, if you look into the balance sheet, you can see that one. Yeah. The total debt is given as a 3,900 crore compared to 1,715 crore. So what do you do with this debt? The company is not going to pay this money. The company is having a huge loss, right? So the loss is how much? 3,000 crore, right? Yeah, this company is having a loss now. Okay, let's see Saran what he said. Saran has sent me privately. Why don't you just put it publicly so that I don't need to read it? Since the business is being diversified, especially biofuel, which has a huge demand in future, it can be profitable. We're not denying that one, right? So it might possible, right? It may be a profitable one, but the question is that what do you do with that the current one on that one? Okay, we'll come back to that and then discuss that particular point. Let's now do quickly, as a private equity fund manager, what is your view on investing in this company? Would you buy the shares, 20 million shares of this company at 15 rupee when the current market price is at 12? Let's change our hat and then being an equity investor. Let's see what is your view on that one. Yeah, what is the justification for the higher price is slightly difficult to say. Because generally, what companies will do when they go for a private placement, they would generally expect a marginally higher price for the simple reason that if you go and buy the same quantity, you may have to pay higher price. So forget about 15. Would you be interested to buy the stock at 12? Would you be interested to buy the stock at 12 rupees instead of 15? If you feel 15 is high price, I cannot give, but what about 12? Great. You said what are the prospects, right? We will see that one. Okay. Now let's quickly, instead of debating the numbers without looking into the ratios, maybe difficult. So what we'll do that we'll quickly put those numbers in this the dew point in the template. So I just entered the numbers. Whatever the numbers which are available, which are related to that one, I entered that one, and all my ratios got updated, and we have this one. Now let us try to understand from this one how this business is doing over a period of a time. So we have a 2010 and we have a 2014. When we have 5 years number, it may be slightly difficult for us to handle all the 5 years number together. Either we can take 2013 and 2014, but since we have slightly a longer period number, let us take 2010, how things were there. That seems to be the good year. 2010 seems to be a profitable year. Therefore, it is much easier for us to compare what went wrong in 2014 compared to 2010. So we have this number. So on the right side, we have a 2010. On the left side, we have a 2014. The ROTA has come down from 11.46% to 0.44%. Right? So less than 1% is what they have return on total asset. So what's the reason? The reason is, to some extent, it is because of the asset turnover ratio. It declined from 1.04 to 1.06, and profit margin declined from 11.1% to 0.5. Actually, we can assess. So the difference is to an extent of 11.46 to 0.44, that's 11%. Now, is it because of the declined asset turnover ratio? Is it because of the profit margin? Of course, from seeing this number, we can say it seems to be because of the profit margin, not from this one. But we can develop a measure to exactly measure what is happening on that one. So we know that these numbers, return on total asset, is a multiplier of these two numbers. So 11.46 is a multiplier of 11.1 and 1.04, and 0.44 is a multiplier of 0.5 and 0.86. So what we can do that, we can keep one of the two numbers as a constant to the last period number and multiply with the revised current year period. So let's see how this is happening. So let us assume my asset turnover ratio has declined, my profit margin remains same at 11.1. So what would have been my return on total asset? So what I will do that, this multiplied by this one. My return on investment, return on total asset would have declined from 11.46 to 9.55. So there would have been about 2% decline because of this asset turnover ratio decline from 1.404 to 0.86. Now we will see how much is happening because of this profit margin decline. So let's assume that I continue to operate with the earlier efficiency of asset turnover ratio, but my profit margin has declined to 0.5. Then this is what would have happened. My profit would have been a 0.52. Now, we clearly now know that it is mainly because the decline is mainly because of the profit margin. 11.1 to 0.5 is causing a reduction from 11.46 to 0.44 by profit we get some idea about what is driving this business. Profit margin is driving the business, and since the profit margin has come down to 0.5, then we have a problem on that one. So the question is that why profit margin has come down from 11.1 to 0.5. So we have few ratios here which we can think about. We find that there's nearly a 6% increase in the raw material to sales cost. There's also a 1% increase in the employee cost as a percentage of sales. There's also other expenses have gone up by 1%. And so when you look into that, and the depreciation values are also gone up on that one. So about 10% numbers have gone down. Nearly 10.6% value has gone down. You can actually figure it out. And each one, how much we have contributed this one. So this contributed 7% out of this 10.6%. Of this 10.6%, 7% is on account of raw material. And then on account of employee cost is 1%. Again 1%. Again 1%. So when you look into that, these three contributed about 1% each, whereas major contributions from the raw material cost. Raw material cost is outside the company's control. The company cannot do anything on that. It's a commodity. The government is fixing the price, and the company actually committed to the farmer. Yes, the sugarcane industry is sugarcane, the agricultural growers. Typically, this industry is slightly different compared to wheat, rice, paddy, or some other commodity, agricultural commodities. When you look into that one, so what these sugar companies will do, they will go and enter into an agreement with the farmers, supplying agreeing to buy a sugar cane. So sometimes the company may also have to give some advance because in sugarcane is not very easy to grow. We have to invest good amount of money. Therefore, the farmers would actually expect some amount of advance as more of a commitment from the sugar companies. So they collect the advance and then start growing on that one. Typically, the prices are either negotiated at that point itself or it is fixed by the state government. So you don't have any control on the raw material prices on that one. On the other hand, you have a problem with the output price. Output price is a typical commodity, so it widely fluctuates in the market. At some point of time, it goes up large. At some point of time, it goes down value on that one. There are multiple countries which are producing the sugar cane, and therefore international prices of sugar is very volatile. Politically, the government, because we said India is a large consumer of sugar cane, sugar as a commodity. Politically, whenever the sugar prices increase in the retail market, there is a lot of pressure to the government to cut down or reduce the price. So what they will do that they open up the import. Once the import started coming in, the sugar price also affected in the market. There are so many problems out there. Therefore, the 7% is beyond the control of this company. If this company moves to 11% profit margin, then they will get back to 9.5%. Of course, there is a small drop, but still the rota will be returned back to that one. So that way, if you look into that, the problem for this company is not in their control, it is beyond their control. Whoever runs the sugar mill, they are having this problem. Right? It's an industry level problem. It is not the company level problem. So this point we need to understand before we move further on that one. We will come back to this point, but we understood now this is the profit margin is the primary reason for the return on total assets to decline. Why profit margin has declined? It is primarily because of the increase in the raw material cost as a percentage of sales. Or rather, raw material costs remain same, but the sales price has gone down, and because of that, the raw material cost as a percentage of sales is increased significantly to extent. So let's come back here in the asset turnover ratio. Let us study quickly how things are happening. So we say that when fixed asset turnover ratio has come down from 3.7 to 2.13, it could also be because of the lower revenue realization. Production-wise, I may be doing the same production, but what I get as a net revenue out of the sale profits is not that much encouraging, that it has come down to from 3.7 to 2.13. Current asset turnover ratio improved, primarily because inventory turnover ratio improved. Inventory days have come down from 81 days to 66 days. Debtors turnover ratio has also improved. Collection days has come down from 20 days to 16 days. Seems to be pretty decent this side. There is some improvement is happening on the current asset side. Fixed asset side, there is a deterioration. That deterioration can be partially on account of the revenue per pound or per kilogram or per ton. The sugar prices have drastically dropped down over a period of a time. I may still have the same production. That's the reason it is causing. So generally we said this side is not that much of a problem area, only the profit margins are problem area. Then coming back to this, the difference between the ROTA and ROCE, earlier the company gained 7% nearly the percentage of increase, but now it is not that much large. It has moved from 0.44 to 0.56 on that one. There could be various reasons. The company may not have used effectively the receivables, payables effectively, and also because in the ROTA itself is very small, the payables may not contribute to a large extent. The killer is this one. The cost of debt is 8.16, whereas the ROCE is 0.56. We are borrowing at 8.16% and using this money to generate a return of 0.56. So there is a negative spread, and that is what causing this impact of leverage is 22.22, and the financial leverage is also very high. So one of you asked me, the risk part is not very clear. This is where the risk part is coming. So the difference between the return on capital employed and the cost of debt, return on capital employed and cost of debt gives you how much the spread you get by using the debt. Debt is an advantage as well as a disadvantage. Debt is beneficial as well as a risk for you. If the spread is a negative, it is a risk. If the spread is a positive, you stand benefit out of the debt. In this particular case, the spread is a negative. 0.56 minus 8.16 is a negative. Multiplied by 2.92, which is a magnifier, which magnifies the profit or loss. The spread is a profit or loss. This financial leverage, which is nothing but the debt by equity, is basically the magnifier. And that is what you see the output of this one. So in the previous year, it contributed 13% because your return on capital employed is 18%, your cost of borrowing is 4.81%. So you have a decent 14% spread. Multiplied by 0.97, you got 13.23, which magnified. Now the same magnification happening, but on the negative side. So it pulled down, the return on equity is a negative now on that one. Taxes actually help because of the losses. You can defer the taxes to the future, and you also get some benefit from the deferred taxes. That's the reason that the impact of the post-tax return on equity is slightly smaller than this one. So this is what we have. Very quickly, the current ratio has improved from 0.94 to 1.35. Debt service coverage ratio has declined. Payable days has also declined from 164 to 104 days. The last thing is that the Z-score, it was 2, which is slightly better, which means that it's not a bad company, but in 2014, it has dropped to 1.17, which is a serious concern for us about the credit, the health of this company on that one. So this is what the chart tells as a kind of the output or health of the business. Now, let me just find out what says that one. It's making loss, so unless we manage differently, the company know not what investing. Due to asset turnover ratio, profit margins for different markets may be different. The Brazil is not the same as India. Yeah, okay. That's possible. We can measure that one. What is the profit margin in these two countries? Actually, the The data which I have given to you is a standalone company, which is a local, the Indian operation only I given you. I have not given you the consolidated data. So, but that data is readily available in the Renuka Sugar company website itself. You can download and then examine what is the consolidated number on that one. So what we are essentially discussing is a standalone Indian operation or Indian company's number is what we are looking into that one. Okay, coming back to this, the first question. So what do you do when you are writing a report to the credit review committee? What we need to tell the credit review committee is that the profitability of the company has declined. The company is posting a loss. The credit worthiness of this company has drastically declined because of these scores are now below the cutoff level. That's number two. But we also tell the credit review committee that most of the things is not on account of the company. The company is actually efficiently being managed, but what is happening is that the external factors are pulling down this company. So we cannot do much because of this one. So only thing is that we need to wait for some more time to see whether this company is able to come back to the normal. Yes, because like any other industry, any other commodity, it's also cyclical in nature. So it's possible that in future the company may come back. But we need to also give a caution to the credit review committee that in future, whenever we are investing in a sugar companies, particularly lending, we need to be a bit more careful when we are lending this one. Too much of exposure, like right now the exposure is of 2.92 is a financial leverage, is too much for this one. So probably we can advise or we can recommend to the credit review committee to have some maximum shares as things, which means that this industry is risky, and adding a financial risk is also not good. So this is one of the things which we discussed. There are two types of risk a business is exposed to. One is what you call the business risk. The other one is called as a financial risk. How do I measure the business risk? You pick up this number, or return on total asset, and take over a period of a time what is the return on total asset, and then find out a simple volatility or a standard deviation measure. If the standard deviation of the return on total asset is high, particularly the negative is moving up and down, volatile, then we declare that the industry business risk is very high. Because here we are not considering the interest, borrowing, nothing we are considering. We are measuring profit before interest and taxes. If ROTA is a volatile, that means the business is risky. The business risk is very high. Take one of this Bollywood movie producer and figure it out. Let's assume that in the last 10 years, 15 years, this person has produced some 20 films or 25 films. And if you're able to get what is the profit you made in each one of these films, and when you try to put those numbers in an Excel sheet and then measure the standard deviation, you will find wide volatility in this number. So our conclusion is that the making movie is a very risky, which is obviously we know that we don't need the data to prove that making movie is a risky business. But if you want to substantiate, we want to demonstrate there is a risk in the business risk is very high, simply make this kind of a chart and then find out, you can see that one. Similar is the case of this particular industry. The business risk is very high. That is the fundamental conclusion we are getting. Now, the question is that what kind of a financial risk this company can have? This company cannot afford to have a huge financial risk because it is actually putting the oil in a fire. The business is already in a fire. Now, if you put an oil, another risk, adding that time, then what will happen is that it will be disastrous. So that is what we need to tell the credit review committee. Look, do not have this kind of a large exposure into this business, as a credit exposure into that business. Okay. I'll take a pass now. I'll ask a question. Whether this particular recommendation to the credit review committee makes sense. I want you to respond. We are recommending to the credit review committee a simple thing. One is that the business profitability has come down. it is very risky. The Z score or some other related score has come down, which is below the credit worthiness of the company. And we also tell this is mainly on account of external development. And we also caution that this is more of a cyclical industry where the profitability of the business is ups and down, and therefore we should not have too much of exposure in this kind of a thing. Sagar says if the external factors are causing reduction in profit, can't company take some precaution to avoid this? May be possible. Many times it may not be possible. What is this company can take precaution? Let's take a sugar company as an example. At best, you can go for a forward contract of the sugar, futures contracts of the sugar for a 1 quarter, but your productions are much larger. Yeah, Raghu Sharma says political sensitive commodity is definitely an issue. Let us not get into too much into that one. To understand, we can do that one. But the fact here is that there is a fundamental business risk is there. This business is not some other business. It is like any other high business risk company or industry. So we need to be very careful when you are doing a lending to this kind of a business. Vinod says we can buy our farms and then do this raw material. We can have a control on the price. Possible, but not sure whether it is practical. In the sense that the quantity is so large, it is not practical for a corporate to buy few, I don't know, thousands or millions of acres of the land and then start growing sugar cane in that and then going for a full production on that one. To some extent they can do, but not. I don't think that it's possible on that one. Paper mills have done. Paper mills have gone and then purchased a forest in Malaysia and other countries, and then they were trying to produce pulp and then doing that one. But there also it's very small quantity. That's the thing, they have to buy it from the market only. Investment in R&D to modify the production process, very good. But these are all slightly less practical. That's what. You can improve the recovery ratio, right? So how much of a sugar cane juice I can get out of sugar when I crush the sugar, doing some R&D. For example, if I'm getting today, let's say 12.3% I'm getting, by doing some R&D, and I can improve the content from 12.3 to maybe 12.5 or 12.8. That much I can do that one, but nothing beyond. We cannot. It is all very well-established industry. It may be difficult unless you have genetically modified the sugar cane kind of a thing. So that may take longer time. So it's not within the control. So coming back to this, the central argument, I want you to appreciate that one. We can do so many things. That is not our objective. We are a lender, and we are trying to assess this company. Our conclusion is that this company is not doing well. That's number one. The credit worthiness of the company has come down. That's number two. But we also conclude, we also tell the credit review committee, it is not because of this company's problem. It's not management failure or something like that, one inefficiency. It is happening because of the external conditions, political, whatever you call that one. That's the reason. And finally, we say that one, when we look into that 5 years data, it looks like a more volatile business return. The ROTA, year on year, when you look into that, it is not stable. It's so highly volatile. And therefore, we recommend to the management, to the banker, we should not have the financial risk exposure for this kind of thing. Do the same thing for Asian Paint. You will see a uptrend or a stability in this one. Do the same thing with Hindustan Unilever or in the international market. You pick up any good company and then try to see how the profitability of the ROTA over a period of a time. If the profitability of the ROTA is stable over a period of a time, which means that the business risk is not very high. Volatile ROTA indicates the business risk is high. So those cases, we need to ensure that our financial risk is not added. Yes, volatility means ups and downs. Mohammed, what is volatility means? There is a ups and downs. This MicroMaster, Advanced Management Program, etc. Let's not discuss now. We can discuss offline. Right? I'll take those questions after the class is over. That's very difficult. All states competing with each other to give the minimum support price. So we can't help that one. And also, you cannot bring the sugarcane from faraway place. That's also a problem. We have to be within this location only, because the transport cost should not take away. Because the sugarcane is a bulk commodity, so we cannot transport for a long duration. So we have to be close by. Each sugar company has something called as a command area. Within that, they need to make the procurement. Okay. Now let's move further on that one. So second question is that, what about this credit application? What do you do with the credit application? Now the answer is very simple. We cannot give the credit to this company. The working capital, they wanted additionally another 500 crore, which we cannot do because there is no justification for us to give. There is no guarantee this money will come back to us. So we should ask the promoters to bring. When the business risk is high, the shareholders should put more money to ensure that the business is not adding any additional risk. So the second is straight away answer. We don't need to debate much. Just take that Z-score or something similar to that Z-score, and we come to conclusion that this company cannot be given any loan at this point of time because the exposure is already very high and everything is now very low. All profitability ratio very low. Whereas internal reason, external reason, etc. is not my concern. I cannot give loan because there is no guarantee that I will get back. I can consider giving the loan provided if the promoter is willing to give some kind of a security, some kind of hypothecation, not from this company, from elsewhere else. For example, if the promoter has another company and if he is willing to pledge the shares of those companies, the assets of those companies, then I can consider this 500 crore. But on the basis of the company's strength, we cannot give this kind of a loan anymore. The matter ends at that particular point of time. Is that okay? One single reason we have to find, or one valid reason we have to find out to give money, and you don't find any valid reason to give money. Every number looks bad here, so there's no point in giving this one. What if the company proposed for a restructuring plan? Those are a good point. We may not have a time to look into that this particular part of restructuring. What is that we will restructure? What is that we will do? If I have, let's say, I have something like a 5 business, I can go and restructure and bring down 1 or 2 businesses and then start looking into that one. I believe that you are from India, Rosie. If you are from India, are you from India, Rosie? Just want to ensure before I give this example. You are from Mauritius. Of course, I believe that you might follow that India's thing. Very interesting. I have some good friends in Mauritius. Right? Let's talk more about this one. There's a company used to be called, even today it's one of the good companies, Larsen & Toubro. Larsen & Toubro has done the restructuring because it has one of the largest cement production facility. But what has happened, it is not consistent with the rest of the business. The company was incurring a huge loss because of the sugar, because of the cement. So finally, they sold the cement division. And that's possible for a restructuring. Restructuring, okay, Margaret asks, what is the meaning of restructuring? Restructuring is that you have 5 businesses or 10 businesses or 10 different countries you are operating. You are trying to geographical restructuring or business restructuring asset restructuring. This is a kind of restructuring which you do, which means that you try to take off the businesses which are not doing very well. So that's called as a restructuring. So here I don't see much the scope for restructuring of this business. What we can do that we can pick up a couple of sugar companies and study how other companies are doing. And if some of the other companies are doing well, then we can go and check why these companies are not doing well, any possibility of restructuring. If at all anything we can do that one, we can ask them to sell off that Brazil unit and then concentrate on India, which may not be a nice decision because the whole strategy will get collapsed. In fact, this is one of the unique strategies this company is trying to build, and now going and asking them to do away with that may not make sense. So I would say that one still, they need to strengthen their equity base. There's no other option. This company, because of the financial risk is very high, they have to do that one. Rosie, I know that you are from Mauritius, therefore you know much about sugar than me, right? I don't know how many of you visited Mauritius. When you go there, you will see a huge sugar cane growing around this country. Specialized sugar, branding, right? That's what we are trying to do that one. Couple of Indian companies started doing the branding, but that is not very successful in a sense that they're still at the small operations. I would say about 3 to 4% of the total sales is coming through the branded sugars. Rest of things, about 95, 96% are coming through only the commodity sales. So what you said is maybe true in Mauritius, but relatively the large consumer base is in India. So here branding of a sugar is slightly difficult, and charging a premium price is also difficult on that one. Yeah. Okay. Let us move to the next question. Okay. On a cash flow statement, there was some mistake on the calculation of AAP. Yeah, I understand adjusted accrual profit. See, adjusted accrual profit is defined as profit before depreciation, interest, and taxes, minus other income, minus taxes. So this is what we say, right? I'm not sure whether we have computed this number here, not sure on that one. But we can do that here. Since we have the data, we can do that here. But I don't know whether we have other income data. Yeah, no, other income data is not, it's given as a 0, but I'm not sure whether it is really a 0 or I have not provided, other case details are not there. Anyway, we will just do that one. Yeah, it is there. So I'm showing you that adjusted accrual profit. Can you tell me I'm not clear. What is that? Sorry for taking you back. There's no problem. Tell me what is that issue. Oh, okay. Okay. Okay, but let me just clarify that one. Adjusted accrual profit is equal to very simple computation. PBDIT minus other income minus taxes paid, or current tax, what we call. This is comparable with the cash flow from operation. So that's what we meant that one. So what we have done for this particular company, we have completed. In fact, I'm very happy that you brought this thing on that one. When you look into that, in both periods, the company is having a positive adjusted accrual profit, but they have a huge negative cash flow from operation. This is another concern. We can always say that it may be because this company is a seasonal product company, and therefore they're bound to have a large quantity of inventory. They should have paid for the farmers to buy the sugar cane, but they also spend money to produce the sugar, but they cannot sell the sugar overnight. So they have to wait fairly for a longer period, then they do that one. But if you look into that, if this cycle gets into a rhythmic thing, then we cannot have this one. Maybe initially you may have to put a working capital margin, but year on year you cannot have a completely a negative number in this one. So this is another concern, right? As a banker, we need to worry whether this company is actually making profit or not. So when you look into the adjusted accrual profit, is 177. Here the depreciation is is also considered as a cash flow, as a profit element. It's a PBDIT, and when you look into that, we are having a positive number, but cash flow from operating activity is still negative. So this is another major concern area for me as a banker to worry on that one. Okay. Please mail me what is the mistake related to the other one so that we can make a correction on that one. So let's quickly get into that private equity. So as a private equity person, we will be looking, one is that we look into the history. Definitely what we have done this analysis is also important for us to take a decision. But we didn't find anything exciting to say this company is doing well, except the fact that we understand that the company's problem is mainly because of the sugarcane prices rather than anything else. But now, I also need to look into that, the future, right? The decision on the decision on the equity investment is partially the historical performance and partially the future outlook of the company. That's what we know. You are right. What would be the probability of the sugarcane price, sugar prices improving in the near future? Right? Then only the company will return to the profit track. Right now, the company is getting to the loss track. Now the question is that how long this company will take to return into the profit track, and then started giving a decent return on equity number. That is what going to decide how much, whether I should invest or not. And then once I decide to invest money, then the next question logically comes into the price on that one. This reversal can happen next year also, quite possible, because let's assume this is one of the very bad year, and this is another the interesting thing in this industry. If the sugarcane growth is very high, it is a problem for sugar manufacturers. Right? You get a point. Because the sugarcane prices are constant, and if the sugarcane production is very high, let's say it's a good year, bumper year as far as agricultural production, then what would happen is that the sugar production will be very large, because we can't turn down buying the sugarcane. We have to buy the sugarcane and then do this one. Now the issue is that one, you have to now see what will be the impact of this in the market price. It will go down. Now, then these companies would not be able to, they will delay the payment, so many things will happen. Then farmers will sense that, then they will reduce the sugarcane growing. Or maybe various other reasons, if the production quantity has come down, sugarcane production comes down, the sugar output will be lower, and that would increase the price of the sugar in the market. Open market price, sugar prices will increase. So it's quite possible next year or 2 years down the line, the sugarcane production is declining because the farmers are moving away from producing the sugarcane, and move to some other commodity. And once they see that every company, sugarcane company, is not doing well, so they will also not willing to go on that one. Then the price might improve on that one. So there are a lot of uncertainties there. It might improve, it may not improve. Everything is possible in this particular industry. So one has to take a very careful analysis about the future. So one has to look into that future a bit carefully and see what the experts say, the sugar growers or sugar uh, analysts are saying about the recovery of the sugar prices. Then only we can take a call on that one. From the historical number, we don't get excited, but if the future looks something better, we can consider. Paying the 5 rupee premium in a loss-making company is something we need to worry on that one. One possibility is that we can look into another parameter like a book value of the company and other things. If they are good, probably we can consider. But unless we are very confident that the sugar prices are going to recover and this company is going to turn around, then it is possible. Even then, if you look into that, for a return on equity of 23%, then we have to really worry whether this 15 rupee is worth for us to pay on that one. Possible, right? The price is not far away from that 10 rupee par value. It is just under 5 rupee premium this company is offering. But at this point of time, I would say that this is not a wise decision to go and invest 20 million shares at 15 rupee, which is 3 rupee premium to the market price on that one. So we can wait and then see how things are happening on that one. So again, the last question is that how do we differentiate our analysis between the lender and investor? Lender looks only the historical data and take the current one and then decide on that one. Whereas equity investor not only look the historical data, but also look into that future data. Future data, future forecasting is something slightly different analysis. It is not what we have done. The geopoint chart is not going to helpful. There we will develop something called as a free cash flow analysis to figure it out how this company is going to have in the future. So we may have to collect a lot more data to do this kind of analysis. Best thing is that you can pick up one of the analyst reports. There are so many analyst reports available on every company in the market. So we can just pick up one of those reports and then see what analysts are saying about this particular equity, the earnings of this company in the future and other things. But since I've seen a couple of reports, I don't find anything exciting for the people to recommend this company is going to do well in the future. So we have to live with this one. Couple of more points I want to tell. This is more of a governance related issue. I'll just take you through that one. You can see that from 2009, 10, 11, 12, 13, 14 data, when you look at this company has given so much of equity dividend. Sorry, I don't know why my. So this company has given so much of equity dividend, 100%, 100%, 100%, and 50%. In 4 years, the company has given a very huge equity dividend. Here is the basic problem. I will get back to my chart mode so that I can watch this one. Okay, before I take up this one, OPEX has come down, is fluctuating now, just as action was taken in controlling fuel cost, power and fuel cost. Yeah, so you know, operation expenses come down. I'm not sure whether it has come down. We saw that everything has gone up here, right? All these expenses are gone up. I don't know why you say it has come down. Oh, has to come down, right? Um, but those things are not going to help them. These are all pretty standard process industry. You cannot do much to control the cost also. If you are inefficient, you can go and control the cost. But if you're already inefficient, there's not much for you to control the cost further. Definitely, raw material price is the critical input in the entire profitability of the sugar business. If you are inefficient here, other expenses, you are inefficient, then you can go and control it. But the 6.6, maybe because of the lower, this is the ratio of other expenses to sales. Other expenses maybe still remains at sales. Realization per unit might have come down, and because of that, it is happening. Okay. Yeah, you're right. Loss on foreign exchange. These are all one-time loss that can be always be fixed. Right? The company has done some foreign exchange transaction, which might have resulted in a loss. This is all risky transaction, and risk has a two sides. One is on the positive side, and the other one is the negative side. So in some years they would have benefited. In some years they would have lost. So this year there happened to be a loss, and the companies will learn from the mistake. And typically, what will happen in many of these cases, the board will, assuming that if the board is a good board, right, a board of directors, they will take a policy decision not to do this kind of transaction in future. So let us concentrate on the business. Let us not get into any of these kind of derivative transactions. This is what most likely companies will come to the conclusion. Coming back to this, my point, the governance point on this particular case is that we just saw that this company has declared a huge dividend. This is typically happen in many companies. The promoter invests a small money to start a company, and then they borrow heavily, run the business for a few years, then go to the public issue. At that particular point of time, they issue shares at 50 rupees, 60 rupees kind of a premium. That's what this company has also done. They came out with a huge, and then when the sugar industry is doing very well, that's the time these companies, no company will come to the IPO when the industry is doing very badly. When the industry is doing good, they will hit the market with a premium price. So they do that, they collect the money, now it becomes a cash-rich company. There's a 10 rupees shares, they sold it for, let's say, 50 rupees. So they have a cash-rich company, and then the next couple of years they declare a dividend. So when they declare a dividend of 100%, 100%, and other thing, so these are the numbers they have declared. So 350% they have declared, which means that the promoter who invested 10 rupees got back 35 rupees out of this one, right? So the money has come back to them. So virtually their investment is zero in that company. Whereas the public investors are still with the company. They all brought 50 rupees price. We don't know whether they got entire 35 or maybe slightly lower. I'm not sure how much they got. Maybe 25 they might have got. The balance 25 is still with the company. Whereas the promoter got back all their investments. They have a zero investment in the company, but they have a very high stake in the company. Then they can happily enjoy this company. They don't bother about what's happening in this company. Right? They just need to make this company to run. So the lenders should also be very careful about this kind of governance issue when they deal with this kind of companies. Right? This is more of a side tracking the discussion which we are trying to do that one. But as an investor, we need to be slightly careful whenever the company is asking for a premium. I would say that the promoters, when they got 35 rupees out of 10 rupees they invested, they should invest back the money into the business. If they have a if they have a faith in the business, they should do this kind of a thing. I'm sorry. Okay. Then the next issue is that Okay. Any other points we want to make before I quickly take you through that Glenmark versus FTC? So we are already 6:10. I don't want to spend too much time of your Saturday evening. Any other observation about this Sri Renuka sugars? Great. Okay. Now let's quickly run through our discussion on the second case. This is a problem with this Mac. Okay, I'm not able to see your the chart things, so let me just continue. I'm not able to do that one. Okay, I have the data of this particular, this is basically the interform comparison. We have two pharmaceutical companies. One is called as a Glenmark and the other one is FTC. Company, slightly a smaller mid-sized company. And you can see, even though the numbers are slightly different, when you look into the revenue, for example, if you look into that, this revenue is about 800 crores. This is about 3 times of that one. But I've taken these two companies for the simple reason that both of them have a few products which are widely used on a day-to-day basis by the people. There's no other reason for me to pick up these two companies. Okay, when I look into that Glenmark, both companies are profitable companies, right? If you look into that profit after tax, so all these numbers are pretty positive, right? Now we try to understand how these two companies are. When I try to benchmark, sorry, how are their performances of these two companies? So I'm not going to put the DuPont chart. Let's quickly compute these ratios to find out how these two companies looks. So return on total asset, let's say. So we know that it is a PBIT divided by total asset. Return on capital employed, PBIT divided by total assets minus current liabilities. Return on equity, pre-tax, profit before tax divided by shareholders' fund. Asset turnover ratio, revenue by total assets. Fixed asset turnover ratio, revenue by fixed asset. Current asset turnover ratio, revenue by current assets. We need to find out what are the current assets: inventory, sundry debtors, cash. That's enough. Inventory days, inventory divided by average sales per day, sales by 365, 32 days of inventory. Collection days, sundry debtors divided by revenue by 365, average sales per day. Raw material to sales, we can easily compute those ratios. Employee cost to sales, selling and administrative expenses by sales, Miscellaneous expense is also a bit large here, so we'll use that. Okay. We got all the ratios ready. What you need to do that we need to just copy paste to the other three. How to get that guys here. Yeah, I think no one has posted anything. So yeah, Mohammed, if you don't know how to use Excel, my suggestion is that there may be a MOOC available on using the Excel, but I'm not sure whether there is any such things. But my suggestion is that try to learn that. Otherwise, there may be so many things available for you to learn. Um, I'm now studying how to use a MacBook, right? So there's all problems, right? Occasionally, we may end up in having to do that one. I want to bring the chat also along with that, but I'm not able to do that. Anyway, so let's quickly run through this discussion, go back to the chart again, and then discuss that one. So Glenmark, if you look into that, they are not doing that much very well. If you look into the ROTA, it's a 10%, 11%, 12.6, whereas FDC is slightly, not slightly, it's almost far away from double that value. ROSI is also pretty good for FDC. When you look into that, it's pretty decent compared to what you see is here. What are the reasons for FDC's better performance? Definitely, the asset turnover ratio is better. It's a 0.58 and 0.83. We'll concentrate on year 14, 0.58 to 0.83. Fixed asset turnover ratio, they are better, but they are not that much better. But current asset turnover ratio is far, far better, particularly the collection days, only just 24 days, these guys, compared to 168 days on that one. When again look into that, the profit margin, we say the profit margins are better here, right? 25%, 36%. What are the reasons? 3% advantage in employee. We are not done profit margin. We'll just quickly conclude that also. Yeah, 21% and 25%, 4% extra. Why that 4% extra is not because of raw material cost, but definitely it's because of the selling and general administrative expenses. They are far, far better. Employee costs also, there's a better which is happening on that one. So overall, when you look into that, FDC is a better company compared to the Glenmark company on the profitability of the companies. And what drives this profitability? There are two things which drives the profitability: asset and cost management. On both asset and cost management, there are scope for improvement for the Glenmark. Glenmark is a 0.58 compared to 0.83. And what is the reason? Not because of the fixed asset turnover ratio, but because of this one. Right? Inventory days are also lower for the Glenmark. So, but this is a major area of concern. Right? So they need to worry about what to do with this one. No, it's again going back to the old one. And when it comes to the profit margin, definitely this is another area of concern for the Glenmark to improve the performance. They are good in this one, raw material. They are okay, not far away, and miscellaneous expense also slightly higher. So if you look into that, there is a cost factor is there on that one, particularly SGA. Why they are spending so much on the selling and general administrative expenses? So we can collect more data because the companies generally give more data in their profit and loss account. So we can go line by line item to find out which component of selling and distribution expenses, administrative expenses are higher for this company. Again, coming back to this, the thing, ROCE to return on equity, pre-tax, So there's not much of a difference between these two. We can just say impact of leverage. The impact of leverage is the difference of these two. So 1.7% is getting, right, 1.18. In FD's case, it happens to be a negative. Return on equity, the impact of leverage seems to be a negative here. Whereas here, some small positives there. Probably both companies may not have borrowed money heavily, so that's the reason. When you look at that, the borrowings are not that much very large. In this case, the borrowing is actually very small on that one, but this company is paying the interest. So it's very unlikely this is pure finance cost. Some finance expenses also, maybe the bank charges, etc., might be included here, and that's the reason it's showing up a slightly higher value. And therefore, we should not take that very seriously here. These two numbers cannot be taken as a representative number to understand the impact of leverage. But if you look at that, the interest, the cost of debt for these companies are coming out like this. Let me just put that here. The cost of debt, when you measure, how do you measure cost of debt? We say that interest cost divided by the debt. So we have in a Glenmark case, it was a 6.56, and then it has moved to 7.65. Whereas in the FDC case, it's all become 104 and 240. It's very unlikely this company will have so much of a borrowing. So what would have happened is that the interest would actually include some of the bank charges, etc. The company has no borrowing. When you look into that, there's only 1.45 compared to 958. The company has virtually no borrowing. So sometimes you may get this kind of a misleading when you use mechanically the formulas. You may have this kind of a problem, but one can figure it out. This is not the correct. So let's not bother too much on that one. So overall, when you look into these two companies to answer this, the case questions on that one, Glenmark performance is improving. When you look into the year on year, 2014 performance is slightly better than 2013 performance. So there is an improvement is happening. Whereas when you look into the FDC, it's more of a status quo. There's not much changes happening, right? The return on equity 25.79 has become 25.82, 25.93 has become 26.14, 21.13 is now 21. So more or less a status quo company. Profit margins remain same, raw material costs remain same, employee costs remain same. And you look into that, everything looks like a very stable business which is seeing, whereas there is an improvement happening in the Glenmark. That is one observation which we have. The second observation which we are having is that this company, this particular FDC, has certain strong areas. What are the strong areas? This company is having a better asset turnover ratio, 0.83 compared to 0.58. Particularly, this is the most important strong area for this company. The collection days. They are able to collect money from the customers much faster compared to the Glenmark. So Glenmark should consciously try to look into this issue and see how best they can improve the collection efficiency without losing the revenue. Sometimes what will happen when you try to become a strict credit control, if you started doing it, you might get affected by the revenue. So we need to be slightly careful on that one. And then we also need to focus, particularly the SDA, to some extent employee cost and miscellaneous expenses. So cost efficiency is something which this company should focus. If they have done these two, probably they could also do 20 plus return kind of a thing from 12% on that one. They may see a significant improvement in this one. Okay, coming back to that, why this improvement has happened? What causes this increase? These numbers are better than last year number. What causes that one? It is to a small extent asset turnover ratio, but a large extent profit margin. 19.7 has become 21.6. That is what contributing to the improvement. Whereas the asset side is not contributing. Actually deteriorated. 95 has become 168, which is a deterioration. So this is what this company has to look into that one. Sometimes the credit collection takes a longer time because of certain things. For example, some years back, many companies which have given sales to the previous Soviet Union, and they all stuck because when the country was getting into deep trouble, political trouble, they could not get back the money, and that runs into several years for them to get back the money. So this would be an extraordinary reason. We need to figure it out whether such kind of a thing is happening on the collection days. Why suddenly 95 itself is wrong, the large number, and it has gone to 168 days. That's why there is a lot of concern about the collection efficiency. Okay, I'll just get back to my chart mode. Okay, what can be done about collection days? We have to figure it. The company has to figure it out. I have no idea about that one. At least neither the case nor the company's annual report has any detailed discussion on why the collection days have gone up. But that's a concern area. Right. Our ratio analysis gives us a symptoms. It is not giving us a solution. Remember. In a year, they almost double. Yeah, correct. Okay. Since we're already closer to 6:30, let me just stop here. And I look forward next week. Next week onwards, we have something completely a different subject. We are not getting into that financial statement. We are going to see more detail into that. The management accounting. We are going to look into the cost data more carefully. And then there are a lot of different kind of learnings you will have from next week. Next 3 weeks, you will have completely a different kind of a learning. And those things are, in my opinion, is much more relevant for our managers. I believe most of you are a manager working somewhere. Therefore, between these two modules, financial statement analysis gives you a very high level, macro level understanding of a business and other things. Whereas what we are going to discuss in the next 3 weeks is more at the micro level, right? So that is what we need to more important. Don't worry, Saran. Next week onwards, things will be much simpler, right? We will be moving from one extreme to other extreme, and everything is just common sense. No accounting regulation, rules, debit, credit, or equation. Nothing is there. Everything is a logic. Right, so you will see completely different things from next week. But anyway, this is also important. That's also important. Now, to perfect this learning, this part of the 3 weeks learning, I strongly recommend you to pick up at least 1 or 2 companies' financial reports. Put that in this data entry. Write down all these things, and then write down. Get this viewpoint chart. Write at least some 10 lines of your observation about this company. How good this company is doing on asset turnover ratio or asset management. How good this company is doing on a cost management. How good this company is doing on a leverage management. How good this company is doing on now we can say that the payables management also. Right? Like that you write these things, and I'm sure that you will get a lot of interest and then do that one. Just to give you, I have also given you in the resource section, you have a data of one second. Yeah. So you have a data of this 500, not 500 companies. I would say that we have a slightly lesser number. This happens. I'm just going to take only 1 more minute to wind up our discussion. Yeah. Okay. So I've given you a large number of companies' data for you, right? So when you look into that, this is available in our resource section. So what you can do that you can pick up any 2 companies of your choice and then analyze that company. Or otherwise, you can just create all these ratios like what I have done it here, right? And then compute all these ratios and then drag it to the rest of the things, and you will get all the ratios at once. It just take another 5 minutes for you to complete this exercise. I have not given you this part of that thing. I want you to learn on your own, and then you can start analyze. For example, there are two companies, Grindwell Norton and Carbon Dam. Both of them are abrasive industry. You can find out what is the difference between these two companies. So look into that. The Grindwell Norton is having 14%, whereas this is 12%. So why Grindwell Norton is better? How this company is doing compared to this one? So we can very quickly start analyzing this one. So you need to practice. Once you have done, that's a permanent knowledge, and after that you don't need to worry about much about the financial accounting. Then you can learn something new on that one. Okay, very good. Happy to see at least 22 of you on the thing. See you next week. And one thing which I feel that our discussion forum is not very healthy compared to the previous courses which are run in the MOOC. I find a lot of discussion used to happen, but unfortunately this time it is not happening. And a couple of you are active, need to initiate. My suggestion that if each one of you analyze one company and then post your comments in the discussion forum, I think that will create a lot of interest and excitement to the other learners. So my request is that please do use this weekend. It won't take more than 15-20 minutes for you to do this analysis and then write some, maybe 10 lines and then post it on that one. Okay, I take leave. So have a great weekend.